Okay, so in this video today, we're going to be talking about something that pretty much every investor is going to experience. If you're a stock picker out there, you've probably experienced this, and I want you guys to be honest. Drop me a comment down below and let me know what your experience was with this, exactly what we're going to talk about today. And if you're new to the stock market, if you are just beginning to explore individual stock ownership, get ready to experience this. And if you plan for it, hopefully you can make better decisions. But what we're going to talk about today is what to do when your stock crashes. And by crash, we're talking about a drop of 20% or more. So you buy a particular stock and then that stock goes down massively. We're talking like 20% or more. What should you do when that happens? And basically what happens, or why this happens, is when people buy what people call a falling knife. Pretty much everybody out there has gotten caught up in these. Personally, I've been caught up in General Electric. That's one of the stocks I'm investing in that has been absolutely a falling knife and a thorn in my side. Recently, I've begun investing in JD.com, another stock that's been hitting 52-week lows week after week. And it's been another stock that has gone down massively from where I purchased it at. But if you guys didn't see my video on JD.com, make sure you guys check that one out, because we talk about how I'm building into a larger position and leaving myself room to lower my cost basis and accumulate more shares at a lower and lower price. So that is the strategy that I follow anytime I'm moving into a particular investment that is hitting 52-week lows. And my personal investing strategy is I like to invest in those battered companies, not companies hitting 52-week highs. But anyways, that is the situation. That is where you are at today. You've bought a stock, you're down massively. What are your options? Number one, like I just discussed, the option I always leave myself is the ability to average down. And one of my cardinal rules for myself is never to go all in on an investment. Anytime I begin investing in a stock, I always set a goal as far as how much I want this company to carry weight in my portfolio. Basically, do I want this to be 10%, 20%, a large position, a minority position? And I have a general idea of how much money I want to have invested in that stock. And then what I'll do is I will buy it in chunks. Typically, it's about a 20%. With JD.com, I invested initially $3,000 in this company of my eventual $10,000 position. So that was a little bit heftier at 30%. But I always leave myself wiggle room to be able to average down and lower my cost basis when I'm investing. So I would never personally go out there and invest all of my money into a stock. Let's say I want to own $10,000 worth of JD.com. I would never just dump $10,000 into that stock, because of the fact that once you do that, you cannot average down unless you're going to put more money into that stock than you originally planned on, which is a poor strategy, because then that stock is going to carry too much weight in your portfolio. So what I do is I set an idea of how much money I want to have invested in that stock, and then I build a meaningful position over time by dollar cost averaging and essentially allowing myself to lower my cost basis. So if you've invested in a company and the stock price has fallen, one option you have is to average down, assuming you haven't put all the money that you're planning on investing in that stock already into shares of that company. Number two, the second thing you can do is take a look at the market sentiment, which is the overall attitude or feelings of investors, and you can determine whether or not market sentiment has anything to do with why that stock has crashed. So let's take JD.com for example. This is a stock that is totally getting battered right now because of the broad market correction and the market sentiment. Right now, we are seeing a bear market with these Chinese stocks. A lot of them are down 20+%. JD.com is down almost 50% from their high of 2018. It is no brainer a bear market. But what you look at is the fact that right now the sentiment towards the Chinese market is very bearish because of the low investor confidence, primarily surrounding, these trade war fears and this shaky ground that they're on right now. So that can be a way for you to understand, why is this stock experiencing a crash or a correction? Oftentimes it's because it's a broad market correction and all of the stocks are being affected as a result. If you're noticing that the market is soaring and your stock is crashing, that's going to be an indicator to you that there's something else going on, and you have to begin to peel back the layers of this onion to understand, okay, what is going on with this particular stock. The third thing you can do if your stock experiences a crash, it's something you should have done already, but if you didn't do it, study the company fundamentals. Understand what is going on with this company. The fundamentals are going to tell you the health of this company. Is this company in good financial health? Are they in declining health? Or are they in poor health? And if you see a change in the balance sheet or a change in the fundamentals, that right there can be a clear indicator to you that, you know what, I don't want to be invested in this company anymore. So I always look at things like the debt of this company. Is debt on the rise? Is debt flat? Is debt declining? I look at revenue. I look at growth of revenue. I look at the asset to debt ratio, all these different things. And if that picture begins to change and that financial health of that company begins to change, then I might decide, you know what, I made a mistake here. This is not a company I would want to invest in. This doesn't meet my criteria as a fundamental investor. I'm going to sell and just basically recognize my loss. And one thing a lot of people don't know is that you can use capital losses to offset capital gains. So there are some situations where it might make sense to just take your loss, cut a loss, and use that to offset some capital gains in the future. But I see that as a worst case scenario. And typically you're not going to see fundamental changes or changes on the balance sheet or these financial documents overnight. If you did your research, you should be able to see the trend of this company. You know, are they in growth mode? Are they stagnant? Is the growth declining? So you should have a general idea of what's going on with this company before you begin investing. But if you never looked at the financial documents, it is definitely time to, if you're seeing a crash taking place, especially if it's not a broad market correction. That's an indicator that something else is going on. Number 4, the fourth thing that you can do, which is often the best option, that is just to stay the course. If you liked this company early on, the fact that the price has changed should have nothing to do with your feelings towards this stock. And you should also remind yourself here that stocks are a long-term investment. In the short term, the prices can change. They can be very erratic. And, especially looking at, 6 months to a year or even 5 years. Investors like Warren Buffett recommend investing for 5 years or longer. Anything less than that is basically speculation. You have no idea what's going to happen with that price. And so oftentimes the best option is just to stay the course. So a couple of reasons why you may see a crash take place with a stock. It could be the fact that a company had weak earnings or they fell short of expectations. An analyst has downgraded that stock. There's a broad market correction taking place. In the case of JD.com, the CEO was arrested. There are so many reasons why a stock can experience a crash, and you really want to identify why is it that this crash has taken place. But oftentimes, staying the course is the best option. If you liked the company to begin with, hopefully your opinion has not changed just because that price has dropped. Number 5, the fifth option, as we mentioned earlier, is just to cut your losses. You're going to use that loss to offset your future capital gains, and there would be a couple reasons why this would happen or why you would do this. Number 1, you did not do your research. You didn't study the company fundamentals, and so once you finally, peeled back the layers of that onion, you were like, you know what, I don't want to be investing in this company. This is the Titanic. I'm done. I want to cut my losses, and you're going to use this as a learning experience. Number 2, you have no idea what you bought. You don't even know what fundamental analysis is. You're brand new to the stock market and you just picked a random stock and now you've experienced a crash. And that's a very dangerous situation to be in because you have no idea what you bought. You have no idea what's going on with this stock. And so you're clueless. You have no input as to what's going on with that stock and you really can't make an informed decision. And to that, I would say you got to kind of learn what you're doing before you begin investing in individual stocks. Or like I said, maybe the management has changed or fundamentals have changed. Something major has happened within that company and you no longer want to be riding that boat. That may be another time when you decide to cut your losses. And then if you do decide to cut your losses, one thing you might want to consider doing is to just invest in index funds. Maybe individual stock picking is not for you if you decided to invest in a company without doing your research or you really don't even know how to research individual stocks. Maybe the better option is just to invest in index funds, and rather than trying to beat the market by picking stocks, you just hold the entire market and hold the broad market. Looking at data from mutual funds and hedge funds, we know that most professional stock pickers do not beat the market. Most people aren't going to beat the market. And so oftentimes the best strategy is just to own the entire market rather than being an individual stock picker. So always consider that option in the back of your mind. Personally, I invest half of my money in individual stocks. The other half, I put it in index funds, and that is my comfort for investing. That is my comfort level. That is my strategy. I like to have half of my money in index funds, half in individual stocks. And right now, because I do have, JD and Alibaba in my portfolio and Facebook, my index funds are totally outperforming my individual stocks. So always consider that as an option, is to invest in index funds rather than being a stock picker. But anyways, guys, that's going to wrap up this video. I do have a companion article that goes along with this over on the Investing Simple blog. It's called What to Do Before, During, and After a Stock Market Crash. So not when an individual stock crashes, when the whole market crashes. So if you guys want to check that out, the link for that article is down in the description below. I would really appreciate it. There's a lot of really good articles over there on the Investing Simple blog. But thank you guys so much for watching this video. Leave me a comment with what stock you held that experienced a 20% drop, and let us know what you decided to do as a result. But anyways, guys, that's going to wrap up this video, and I will see you in the next one.